Does it work now? Can anybody hear me? Check, check. That's fucking hilarious. All right. Well, now at least we will lose anybody that couldn't make it through 3 minutes of this in the replay. Maybe I'll be able to edit it later. Sorry about that. I have absolutely no idea what I just did. I just logged off and logged back on again. What I was saying was I was trying to buy tickets for Jason Isbell at 10 a.m. and I got to the final page and then it just said they weren't on sale. So I'm kind of pissed off and I'm going to keep checking that website to see if I can buy tickets for it while I talk to you fools. That's all you missed. I haven't done YouTube in a long time. It's been, I think, about it almost 2 months. And actually, I'm not regretting it as much as I thought I would. Usually I set these up in the morning and then by the time 10 a.m. comes, I think, why the fuck did I just say I was going to do this? But I'm feeling pretty good right now. So let's talk about all my ideas. Why don't we start with the biggest position to the most irrelevant position? Um, Obviously, the most important ones to talk about today are PLYM, Forward, FWRD, YEXT, YEXT. We'll talk PRTA a little bit. ETNB is a CVR that's closing today. I'm going to talk about. Maybe talk a little bit about PTGX since there was an article about that. I haven't discussed that. A little on BBIO. And I have a new idea I'm going to talk about. Yeah, that'll probably wrap it up. So let's start with PLYM. So I did a couple videos on this already. I don't want to repeat what I said in the previous videos. So I would encourage you to go watch those videos if for some reason you haven't. But this one is so bizarre to me. Every day I look at it, it's only been, I guess, 3 days. I think I don't know how big I should be in it because no size seems big enough. I know that sounds ridiculous, but if you look at the setup here, it's trading at 21.89, and there probably should be about a 1.5% gross spread in it. So it probably should be trading at like 21.70 or 21.65, something like that, if there was no possibility of a competing bid in the go shop. So if we use 21.70, there's 20 cents priced in right now for the go shop. And I think if there is a superior bid that's made, I would think that it should be for at least $24. I know I'm kind of anchoring on the 24.10 that 6th Street offered, but quite frankly, I thought it was going to go for more than that. I thought it would go for about 25 when all was said and done. And I based on the fact that you've had the 10-year move in the last 2 months and you've had the comps move. So together, it's the bid is probably worth 10% more from mid-August to today. And then you can also look at a bunch of other factors with what the blended cap rate was and what the company was paying for assets over the last 6 to 9 months, what they valued the joint venture in Chicago at, in Illinois at last summer. All of it points to a cap rate south of 7%, which should get you to a stock north of $24. And the thing that I keep coming back to here is I reread the 13D letter from 6th Street yesterday, and there's some things in that letter that just blow my mind. So, they say in the letter they have an intimate understanding of every asset of the company based on their underwriting of the company last summer. And then if you add that with the public disclosures the company does in the 10K, you can very easily do your due diligence on Plymouth without any material inside information here, right? You know how long the leases are for, you know what the lease rates are at, and what concentration risk you have across all the assets. And these guys knew even more because they were given access to a quote unquote, a data room last summer to underwrite the deal that they did with Illinois. And I'm sure that was just one of many possibilities they were approached to do with Plymouth to gain access to capital. So I'm sure they did look at all the assets. So if you move forward to today, 2 months after they filed that 13D, you have to ask yourself why they didn't end up buying these assets. And again, the possibilities are really limited here. It's either They never wanted to own the assets. So the purpose of the 13D and the bid in August was just to put the company in play. And if that was the case, you have to explain to me how they got a buyer for the company in 10 weeks from that 13D that was not Plymouth, that was at a price substantially below the price that Plymouth offered. Again, this is under the assumption that the bid was fake, that there was no need for them to buy it. The pushback I give you there is Plymouth owns no stock. They have a preferred that they're going to get made whole on when this closes. And I think the estimate is that they'll make about $40 million from that preferred. And then they have these warrants that are going to be zeroed out. And the warrants would have been worth potentially tens of millions of dollars in 4 years when they matured. So the most important thing to realize here, though, is that all of this stuff is very immaterial for Sixth Street. Sixth Street is a $125 billion firm, AUM. Who knows how much they have in the real estate funds, but tens of millions is not what they're doing this stuff for, right? They're doing it for hundreds of millions. And it makes so little sense to me how they would have been involved if they were just trying to get this company sold to someone that wasn't them. So Tom just wrote here, confidential agreement with Macora was signed before Sixth Street proposal. Well, that is very interesting, Tom. And that's a really good catch that I did not catch. And if that's true, which to me seems like it has to be true because they could never have got a deal done with Macora in 10 weeks, then the most likely outcome here is, I think this is kind of what my friend Andrew has proposed, is that Sixth Street got wind of a deal being formed by Macora. They didn't like the proposed deal, and they thought they would come in and try to fuck it up with their 2410 bid. They might have been in exclusive talks with Macora and remained in exclusive talks with Macora throughout August and September. And the board decided that they wanted to sign with Macora. And the way that they get cover for that is they do the go shop. And then that gives them any kind of cover with not engaging with Sixth Street post the August letter. Now you can ask yourself, if they knew that Sixth Street was offering $2.10 more than Macora, why would they not engage them? There's a variety of reasons why that could be the case. Namely, they were in exclusive talks already with Macora, and they thought that was the most certain way to get a conclusion here with a go shop. The part that's so confusing is that I always view Sixth Street as a friendly buyer, right? They worked with them since last summer. They were clearly their firm of choice to do the joint venture with. And exclusivities don't last 90 days. So you would have thought that the Macora exclusivity would have died off by the time that this deal was signed, aka they should have been able to, or EG, I should say, they should have been able to negotiate with Sixth Street sometime between that middle of August and the end of October, and they did not. The other question you have to ask yourself, which again, I did not know that, Tom, which just makes me even more bullish. You have to ask yourself is, did they do a full process? Right? And I know the answer to this has to be no. Did they do a process starting in April? And then Macora was the top bid at 22. And then they went exclusive with Macora. The reason why I know the answer to this has to be no is if they did a full process and then went exclusive with Macora, Sixth Street doesn't just show up in August with a 2410 bid. They would have been part of the process. And they wouldn't have bid 22, and the board would not have went with Macora as an exclusive negotiation. So now you're left with what happens. Okay. Sixth Street has a reputation to uphold. And part of their reputation is not interloping with 13D letters with joint venture partners, right? And they, as far as I can tell, they gain nothing from doing that if they weren't actually interested in buying this. So then the question you have to ask yourself, and I keep saying that phrase, is have they changed their mind since then? Let's assume they were not engaged with, and the board decided to go with Macora instead of 6th Street for certainty, and maybe because they just didn't like 6th Street and they wanted to keep their jobs because Macora has no platform. They're a brand new fund, and they, as again, I had to Angie with this. I didn't even think about this. They're much more likely to keep their jobs with Macora because they don't have any platform. 6th Street is a giant real estate private equity firm, and they do other things too. They almost certainly would fire the management team here, and certainly the board, of course. So I don't think 6th Street has changed their mind, and a $15 million break fee is certainly not going to be enough for them to dissuade them to go forward here. To me, that would put, an 80+% chance that they move forward with this, with 20% being that they just don't want to deal with the reputational risk of interloping during a go shop period. But they've already kind of done that with their 13D letter in August, right? They knew what they were doing. They knew that they were in an exclusive an arrangement with Macora. They were probably told by the board no. So then they did the 13D letter. And I'm not sure anything has changed today versus 2 months ago that would make them be nervous or uninterested in bidding during the go shop. And then finally, you have other third parties, right? If we've come to the conclusion that this wasn't a full process because 6th Street was not invited to bid in June or July, then nobody else was invited to bid in June or July, just Macora. So there's dozens of private equity real estate firms that would find this attractive at a cap rate south of 7. So you could have multiple bids during the go shop. So you're paying 20 cents for that when the upside is, I guess in the worst case, it would be a $23. They really can't bid less than that because the board won't consider it superior. Even you think you could bid $22.01, but you can't do that. The board has to think it's reasonably certain and superior to close and sign. You have to sign contract. So 23 would be probably the lowest you would ever get, and then Macora could come back and match. And there could be multiple other parties that are interested in this. So I love Plymouth. It's one of the most unique go shops I've ever seen. This is not a hard to value operating company where you're left with all sorts of different risks when it comes to betting on the go shop. There could be black swan risk that the original deal breaks from God knows what happens to the core business. That's just not the case here. So it's a 40% position for me. Honestly, I'd be comfortable with it being a 75% position. It's just purely a margin issue, why it's not bigger than 40% right now. I say all this with the big caveat that go shops almost always never work. Maybe 1 in 20 works. And here you're really only paying for 1 in 10 with the 20 cents down and the $2 up. So yeah, I like Plymouth a lot. Thanks, Tom, for noticing that. That's a huge point, or a huge data point that I should have saw in the merger agreement, and I didn't see that, or I should have saw that in one of the filings. And they had to have the confidentiality agreement done before that, because again, you can't sign this deal in 10 weeks. You can't go from high to signing something that requires so much due diligence for someone that's on the outside that hasn't looked at these assets yet in 10 weeks. This is like a 4 or 5 month kind of thing is what I would think, at least 4 months. So Plymouth, let's talk forward, because this one is super hairy and I've already lost so much money on it. At the risk of being wrong twice on the same name. I think forward right now is uh, tremendously more interesting than it was uh, when I first pitched it at 29, 28, $30. I think you have to look at it in two different buckets. Okay. When the stock was trading at 27, 28, 29, $30, we were under the impression there were five bidders for the assets, and everybody was aligned on the board to sell the company, and that whatever the clearing bid is of those five bidders, they're going to take it. Okay. This was like mid July. Okay. We're now sitting here at the end of October. We know with pretty much certainty that the prices that came in for those assets, I mean, for forward, were too low for the board. According to Axios Pro, I did not talk about this in my last YouTube, but I feel comfortable doing it now because somebody tweeted out the article. The board's expectations were for as much as $40 a share, at least at the beginning of the process, or at some point in the process. It doesn't say when. And the two bidders that were left, which are Clearlake and Apollo, doesn't say if they're working together or alone, though it's not that big of a deal. So they probably were doing this alone. Those bids were not significant, not at the level that the board wanted. And there's no imminent deal. They remain far apart, it says. And it says that they're now engaging with strategic to see whether or not they can, find someone from a strategic perspective to buy them. So we're sitting here at $20 a share, okay, instead of being at $29 a share. And we know that there's not going to be an easy solution or conclusion here. Now, when it was $29 a share, a lot of people thought this would sell for $40, high 30s, 40, low 40s, whatever. And unfortunately, I also thought there was a decent chance of that because I had a huge common position. Now, most of my position was structured as call spreads, 25, 30 call spreads. And a ton of them expired in October. I mean, I've taken huge losses here. I'm down well over 1,000 basis points on forward, split between common and call spreads. Maybe about 1,000 basis points, and a lot of that's realized losses in October. So as we sit here today at $20, what is going on there, and what are your risks, and what are your potential rewards? Okay. Well, what scares people the most about this idea is that there's a ton of debt on it, right? I think there's like over $2 billion in debt, or around $2 billion in debt. And it's very levered, right? That's with $300 million of EBITDA. These are all just round, I'm not very good at details, which is some people would say would be one of my many shortfalls in investing. The reason why I don't seem like I'm very detail oriented with this kind of stuff is I'm very much a big picture guy. And like, if I can't get an idea right with very round numbers and round estimating, then it's not going to be worth it all being involved. So let me see what it says here. I don't even have it close to by. Anyway, you can look up the numbers, but I think they wanted a $3 billion enterprise value, which is $40 a share. I think that would have been like 1.2 billion equity market cap, something like that. I'm going to see if my tickets are available now. Sorry, hold on one second. Nope, they're not. Okay. So your big risk here is that this is a zero. Okay. There's whatever it is, $1.8 billion of debt, $300 million of EBITDA. It's a very EBITDA sensitive company with a lot of operating leverage. And you're at a cyclical low, and the comps haven't been doing great. They've been doing better in the last 4 weeks, but they were doing really bad. Okay. So I do not think that there is any chance of this being a zero in any time in the near future. Okay. And my rationalization for that is I do believe that Clearlake and Apollo are still there and they have bids for the company. Okay. It did not say that they've walked. It did not say that they've changed their mind. It said that there's a big bid ask gap between Apollo and Clearlake and the company. So what could their bids be? Okay. The stock was trading 28 to 31 for most of July, August, and September. Okay. It's very hard for me to believe that at least one of them didn't bid at least $25 a share. Okay. They're not going to bid $20 a share. Obviously, that's never going to get it done, right? In any way. The company would just remain public and hope they have a turnaround in the next year, 18 months, and gamble with the leverage and let equity shareholders participate in the upside, not give it to the private equity firms. So to me, the low end was $25 would be their bid. Okay. Why is that significant? Well, we're trading at $20 right now. So if the company was to agree to a $25 bid at some point, that's a substantial upside from $20. It just is. Okay. That's the first point. The second point is I think that I don't think the business imploded in quarter three. And I think that they still see substantial value at forward. Now, the risk is that the business did deteriorate in quarter three. And that's why initial bids that might have been in the low 30s, which I think they probably were, might now be mid to high 20s. Now, Axios says the company wants $40 a share. So even if they bid 30, the gap between 30 and 40 is substantial. That's not easy to bridge, okay? But the most important part is if the company wants 40 and the private equity buyers are at 25, this is not a near-term zero, or this isn't even a near-term $10 stock. Okay. Yes, things can be very gross on a break. And in fact, this stock went to $16 on the Axios Pro article like that. Before it rebounded back to 19 as people that got to see it digested what it said. But to me, I think it's just a very attractive setup because I do think this will ultimately be sold to one of the two private equity buyers. And I think it will be between $28 and $30 a share. And I think it could happen as quickly as earnings next week. Why do I think that? And this is not a likely outcome, okay? So when things get leaked, they're not usually leaked with just kind of the bankers are very careful to not leak something that's then going to turn out to be untrue, right? And for them to say they're very far apart and no deal is imminent means it kind of did get cold. And I doubt they're actively engaged, or they were actively engaged with those private equity buyers at that time. And I do believe they probably were reaching out to strategics, though, the odds of that happening and anything happening there in the near or medium term are very low, right? They could have sold to strategics months ago or engaged with strategics, and they didn't. So what I think they're doing is they're waiting for the kind of boiler pot moment, which is earnings. And that is the catalyst to either get a near-term deal, to announce it at earnings, or to reset the stock post earnings, because I'm guessing earnings aren't that great. I also do think the stock has been reset though, but maybe the stock goes to 16, 17, 18 post earnings. Okay. That would be my kind of worst case scenario. With a caveat, if they do end the process formally at earnings, easily can go below $15. Okay. All the things I'm saying, while I believe them to be true, I don't think anyone will care at that moment, right? What I think the company, what the board thinks it's worth, what the private bids were. If there's no process anymore, if they formally kill it, I do think the stock could go to 15 or even potentially below, but I'm going to use 15 as my downside. So it's $5 down in kind of, to me, the black swan outcome, which is they kill the process and earnings are just whatever. You can use lower. I just don't think it's going to go lower than 15. In the upside outcome, you get a deal somewhere between 25 and 30. I think more like 28 to 30. Or you get okay earnings, but the process is ongoing. And I can't overstate enough how much everybody involved in this thing is aligned to have a deal, right? Clear Lake owns 10% of the company and they're one of the bidders. So they don't want to be left owning the stock with a break, though obviously owning 10% of shit is better than owning 100% of shit. So they're not going to throw bad money after good if they can't get a good price and a good deal. Okay. And then you have the Omni venture capital firm on the board, private equity firm on the board, and they own like 15% of the company, them and their LPs. And that's their exit out of this, right? And then you have the really weird thing with the other private equity firm, the guy resigning from the board at the end of August. And we still don't know why that happened, right? It wasn't so he could sell the stock. They can't sell the stock with all the inside information they have. So who knows why he decided to opt out of being involved in this process. We were speculating that maybe they're going to be involved in rolling and being part of the buying group. And I still think that's possible. So To sum it all up, I think that earnings are not going to be great. I don't think that they're going to be atrocious, but I think the market's expecting them not to be great. I think the odd that the process of formally dies at earnings is low, maybe 10 or 15%. The odds of a deal at earnings is decent, maybe 25%. And then the odds of the other bucket, the process is ongoing and earnings are fine, is like 60%. So you have kind of like an 85% chance of good or great and 15% chance of disaster. And on a weighted average basis at 20 bucks, that's really good, right? Let's be clear. If earnings are really bad and this process is dead, they kind of have to pre-announce and announce the process is dead, right? To sit on that all the way till next week is very bad. Now, it could be on a hanging by a thread, but what I would propose is that if earnings are really that bad and those bidders are still there, they would just take the $25 and they'll take it at earnings. So they'll report a bad print and they're going to sell for 25 bucks. I mean, could they sell for 22 or $23 at the bad print? Anything's possible. I think that's extraordinarily unlikely. And for the buyer, it's such a small amount of money because the equity is such a small sliver of the total EV that I just don't see that happening. But look, this is a good business in a multi-year cyclical downturn. And, it's anyone's guess what happens from an earnings standpoint. But from a process standpoint, this is far from over. You have a board that's good. It's been refreshed. You have the bad board members all resigning in May, and I don't have to worry about that being the impetus in this not going through. You also have a new management team, so it's a big position for me. It's 30% delta adjusted. I've already lost, like I said, 1,000 basis points on it. If it gets sold for 30, I'll probably break even. My favorite spreads, which you can't put on for what I paid for them, but to me, I think that they're pretty undervalued. And I'm only doing these because I have so many 25/30s already on throughout all of the months. Is I've been putting on 20/25s and 22/50 25s. You're better off probably with 20/25s. And I mean, really, any month starting in January is fine, but the ones I've been buying is March. I've been paying $1.80, but even paying up to $2 for those, it's again, I don't see a deal less than 25. So that's 3 up, 2 down. That's only betting a 40% chance of a deal between now and March. If they do end up with strategic, they should get it done by March. And then you have a chance that you get to see earnings for Q4. So let's say they do have a soft quarter and the stock goes to 15. If they put up a decent number in February of next year, the stock easily could be $25 on its own because, again, there's so much leverage in the business. So, I think common is probably the best way to go at $20. But if you want to do some sort of mix or you max out on your risk in common, that's how I always do it. I layer on the call spreads. Wow, that was a lot. Sorry about that. Let's move on to Yext. So Yext is finally at a time frame where it's getting really interesting. Okay, I've been very dejected recently with all of my blowups, and it's hard to stay confident when you're getting so many special situations wrong. I got SWTX wrong, I got SGRY wrong, I got BHF wrong, and I got forward wrong. And I'm not so sure that I've gotten really any right this year. TSVT I got right. I'm not sure I pitched that on YouTube because it was so small. It's been a really bad year with M&A and, as Andrew calls them, for sales. With Yext, it's now been 2.5 months. I never thought it would get done that quickly. So we're now finally in the go zone of when this deal could happen. And they easily, and I'm sure they have, and they're done with vetting potential third parties that would be interested. So all that's left at this point is either they're working with a third party to sell the company to them, or the management team and their partners, the CEO's partners, are finalizing their bid and their financing, and they're going to own this. So your question then you have to ask yourself is, what are the odds that they've changed their mind? One, what are the odds that the special committee, which has a 10% holder on it, rejects their best bid? Two, and then three, what is going to be the best bid that the special committee takes? So let's start in order. So did they change their mind? I don't know what would have happened in the last 10 weeks for them to change their mind. Software stocks have been weak, but I would very much be shocked if something material has changed in Yex's business in the last 10 weeks to make them change their mind. So, I'm going to go with no. They didn't change their mind. With Target Hospitality, we know what happened there. They lost their contracts, lost one contract, and we're about to lose the second. With Surgery Partners, we don't know what happened there. They tried to word it to where it was that they couldn't agree on price, and they walked because of the price. They couldn't agree on price. I still kind of tend to think that is what happened there, but we'll never know. So the question is, did they change their mind? Will they change their mind? I don't think Yex will change their mind. So your second question is, what will the price be, and will the special committee agree to it? This is a weird one because the 10% holder's on the board, and he's been involved with it for years. And the only way I think they would turn down a decent bid by the management team and their their financing partners is if they really saw kind of a crazy blue sky outcome with Yext and AI over the next couple of years. We're talking like a $15, $20 stock price. And if they did, then yes, I think they could tell them, no, we're not going to sell to you. If that's the case, I would hope that break isn't that bad, right? I mean, this stock was only trading at the low eights going into this. And I thought the earnings were fine, not great versus expectations. But I wouldn't have thought the stock would have traded down much on that print. So, for me, I use low eights as kind of my unaffected here, which is what a 30-day VWAP would have been, and also what that stock was actually trading at the day before the $9 bid. So that leads you with the third question. What will this sell for? I mean, listen, I've been so dejected over the last few months. I originally told you there's no way under God's green earth that the special committee or the management team to get this for less than $10 a share. Now, I still kind of do believe that, okay? $10 a share would be like $1.90 or $1.80 off of unaffected. And that is less than a 25% premium for a merger. And companies don't get acquired for 25% premiums, especially not management buyouts. It just doesn't happen, right? You really have to start with a 30% premium and go up from there. It just doesn't happen. You might see a high teens, low 20s takeout in some boring, real estate companies or banks where maybe they're traded off of book value. But it's very unheard of for an unlevered, not net cash company to have that kind of low premium. Like, to give you an example, if the stock had $6 in cash and the business was only being valued at $2, then yes, you can argue if it gets taken out for 10, that's a $4 equity price, and it's 100% enterprise value premium. But here, there's no kind of net debt or net cash, so it's all company. And I just don't really see a scenario where it could get taken out for less than $10. So let's say it gets taken out at $9.50. Okay, it's definitely not getting taken out at $9. It's just not happening. So let's say it gets taken out at $9.50. You're looking at from here $1.10 up, which is a substantial return. That's like a whatever it is, 12, 13% return. And then your question is, what's the break price? And I don't see break here being very bad in any outcome. But for conservative purposes, why don't we use $7 as a break price here? So it's $1.40 down, $1.10 up. And to me, that's in the absolute worst outcome here of a deal where management buys it, there's no third party interested, and they somehow get it for $9.50, which is $1.30 or $1.40 premium on an $8.10 or $8.20 stock. They would be getting it for, if I use $1.35 and I use $8.20, they'd be getting it for a 16% premium, which again, it's unheard of. Okay. So I don't even think it's even realistic, but that's what I'm using. Now, in the other outcomes where management pays 10 bucks or a third party comes in and is willing to buy this for $10 or more, obviously your upside downside skew is way better. So if I was really doing this in what I think is the likely outcome, I would use my expected value being $10 because I think it could be higher than 10, 950 as the low end, 1050 as the upper end, maybe $10 as your expected value. And I would use a buck 60 up, a buck 40 down, and I would say 80% chance minimum there's some sort of deal that happens. That's a very attractive expected value. And then you also have it happening probably in the next 5 weeks because you have earnings the first week of December. And I don't think this is the kind of deal that would take 6 months to wrap up. Obviously, the management team is very intimately already involved with the company. So their due diligence requires pretty much zero. It's just whoever's borrowing and putting up the rest of the money for the business. Somebody has asked, how do you think the CEO would finance this bid? PR says backed by reputable and well-capitalized finance sources, but doesn't seem like the type of deal traditional banks would finance. So, Tom, I think I talked about this in a previous YouTube. The CEO has two partners that he has made hundreds of millions of dollars with previously. First, at his company in the he has previously sold two companies with two other friends, and both sold for like $800 million. I forget, one's like Romley, or I can't even remember the names of the companies, but they're very wealthy. So each of those guys is worth probably at least a few $100 million, and I think the CEO is worth at least $100 million. So my guess is they're going to put up equity financing, and I do think this is the kind of deal you could borrow a $500 million for pretty easily. Money is just so free right now. So I don't think the financing here would be very difficult. There's a chance, I think very low, that the 10% holder rolls as well. But it's my understanding that 10% holder is on the special committee. So if he's on the special committee, he can't roll. And he also would have had to put a 13D out saying he was considering rolling. Um, I do not think the CEO is fucking around here. I don't think the CEO did this to put the company in play for someone else to buy. I think that he definitely has the money and the intention to acquire this somewhere between 950 and $10 a share, and he's ready and willing to do it. Uh, and the only question is whether or not there's a third party that's interested in paying more. And I don't think that that is a 0% chance, but we won't know until we know. So, yeah, that's my take there. So I still really like Yext. It's a huge position. That's also like a 30 something percent position. It's a mix between options and common again. Um, I find the January 750 calls at $1.20 pretty attractive. If there's a 950 deal, those are worth $2. Should trade pretty close to that by the January OpEx. Um, Maybe they'll trade a buck 90 or a buck 85. You're paying a buck 20, and that's a 950. So really good binary risk reward there for the calls. I prefer common because I just don't think the stock's going to go below $7 in a break, and I don't think it's going to break. I think he's a very serious guy. If you read the press release, he made it sound like now is the time to fucking do this. It's time to take this private. He's been involved for a very long time, and he knows a lot of people. So I think I think it'll be a pretty robust process for people that might be interested in being involved, but they're more likely to be on his team and be part of the buyout group than competing against him. Oof, I'm long-winded. PRTA, nothing to talk about there. That thing's been fucking awesome. It's still a huge position. Obviously, most of the juice there is gone, at least in the near term. Somebody put out a report yesterday valuing it at $36 a share. All he was doing was taking very aggressive valuations for each of the partnered programs. That's in a catalyst void for a while now. The company should liquidate and wind down. I'm not of the belief they're going to do that. I have no idea what all the employees are doing there. That would be the next catalyst, would be that they read out the BMY trial next year, the phase one, and they announce they're going to wind down the company. They're also implementing a stock buyback that should start towards the end of this year or in January. And I still love PRTA. It's just not the risk to benefit that it was when I was pitching it at 6, right? I think I originally told you guys on here I wouldn't start selling it till 10, and yeah, now it's 10.70. So I've lightened up, but I mean I still own over half. It's a huge position. It's like 20. It's a 20% position here, and I'm very comfortable with it being 20% position. There's a CVR that closes today. ETNB. ETNB is trading at 1484. I really like the CVR, but it's not without its risks. So very briefly, you're paying 34 cents right now for the CVR, and there's 3 milestones. The most important one is a $2 milestone if they get approval and first sale of their drug for F4 in F4 patients. Don't even begin to think I know what that fucking means. They're currently running 2 trials, one in F2 and F3 patients and one in F4 patients. If they get the F4 patients approved and first sale is done by March 31st, 2030, you get $2. Why I find this interesting. So the board has a 40% probability of success on this milestone. That's 80 cents a share, not discounted. You're paying 34 cents for it. More interestingly, the board has 50% probability of successes for the other 2 milestones, which is $1.50 if they reach 3 billion of sales by 2033 and $2.50 if they reach 4 billion of sales by 2035. I think those are the right numbers. Okay. The only way they hit that is if they get F4 approved and they have a very high purchase price for the drug in F4. That has value, those 2. What are they? It's worth at least a nickel each, right? So at a nickel each, you're only paying 24 cents for the F4 milestone. Here's your risk here, and this has really hit home recently with INBX. INBX is a CVR that just read out. It's positive. These deadlines suck. Okay, with INBX, you have to have that approved and sold by June 30th, 2027. And Sanofi just announced they're going to file in the second half of 2026. And if it's a standard review, that will not cut it. You will miss the buyout by a few months. And that is so painful because obviously that drug had a very high success chance of probability of success, and it read out great. But if they wait until the second half of 2026, you need priority review in that drug to get paid in that CVR. And you also need it launched. I think you need to have first sale. But maybe actually, I think that's just approval. I think that's just approval. That's not first sale. I think there's a decent chance that INBX gets priority review. It's a phase 2 accelerated approval drug. It seems unlikely a phase 2 accelerated approval drug wouldn't be important enough for priority review, but it's just versus standard of care, and it's kind of a convenience thing. It's 3 or 4 week dosing versus, I think, weekly dosing for standard of care. So it's not going to change anything about quality of life for those patients. I have absolutely no idea if it gets priority review. I do think it'll be a pretty decent lawsuit if, BMYRT style, if they wait till the second half of 2026 to file when the drug read out in August of 2025. What does that all mean? So with ETNB, they still have to fully enroll this trial. So there's a ton of risk that between now and call it next summer, they don't get the trial fully enrolled. Once the trial is fully enrolled in ETNB, it takes 2 years to read out. They're currently expecting the trial to be fully enrolled, I think, by April or May of next year. And they should have pretty good line of sight of that because we're sitting in October right now. But let's say it takes until September or October to fully enroll that trial. That means it won't read out until October. Sorry, it won't have its final data point until October of 2028. Let's assume it takes 10 weeks to read out. Okay, that is January 1st, 2029. This will get priority review. I'm all but certain of that, ETNB. Okay, though There's some risk that there's competitor products out there already at that time, but it has a breakthrough designation, so I feel very good about it getting priority review, but you don't know for sure, okay? So if they file that by the summer, 6 months after it reads out, you will have that approved by March 31st, 2030, okay? But there's all sorts of ways for them to play with shenanigans and delay it by a few months so it misses that March 31st, 2030 deadline. One really interesting thing in the proxy is that originally the buyer, I believe the buyer is Roche, but I could be wrong. The buyer wanted a December 31st, 2029 deadline. And they pushed it back to March 31st. The seller, ETNB, wanted June 30th, and the buyer said, no, we want March 31st, 2030. So the seller did want 3 more months, and they wouldn't give it to them. The part that's scary here is we don't know why the company's at a 40% probability of success when they're at a 50% probability of success for those sales milestones. I say this because if they don't get approval for F4, they can't hit those sales milestones. So my guess is the company is very confident that they're going to get this drug approved. They just don't know if it's going to happen by that deadline. And that is why it's 34-cent CVR. So I've sized this very big. It's a 30% position with about a, I think I said it was like an 80 basis point CVR. And I might buy more into the close. We'll see. It's been trading very tight, this 1 cent wide thing. So I don't expect anything to move much between now and the next 2 hours. But usually I like buying these things market on closes. And I like the CVR a lot. It's not without its risks, but I like it a lot. It's a 4-year payout for $2, and you're paying 34 cents. And then you have a decent chance, albeit small, I guess those can't be the same thing, a small but decent, that you have the $1.50 and the $2.50 milestone hit. But I'm dead. This has been too long. This is a 50-minute YouTube. Really quick, PTGX. I've owned that for a couple of years. I do think Johnson & Johnson does buy them. I don't know what the price is going to be. I think it's an attractive asset for Johnson & Johnson. I think they'll probably do some sort of potentially a RemainCo spin out of the company, though I think Johnson & Johnson wants them for the next generation drug too. So maybe they just swallow the whole thing. Who knows, right? Really briefly, the new idea. My new idea is Grinder. This one is super hairy. Tons of there's just every joke I can make about Grinder. I don't even want to do it. It's too easy. But I put this on yesterday. It's about a 7% position now. Grinder's really simple. The stock was in a free fall in September and October because Facebook is rumored to be competing, or maybe they announced they're going to compete in the online dating world. You can look at Match, look at Bumble. All the charts look exactly the same. As a result of that free fall, one of the 2 shareholders of Grindr was facing margin calls and getting liquidated on a daily basis. There's 2 majority shareholders here. There's a 50% shareholder and there's a 12% shareholder. The 50%, think of the 50% as the top and the 12% as the bottom. Okay, the top has not had to liquidate any of their stock. So the top is not suffering margin calls, while the bottom is taking it in the tuchus and getting liquidated on a almost daily basis. Okay, and really feeling the pain. So what happened? You had the top and the bottom work together to announce that they were interested in acquiring all the shares they don't own for at least $15 a share. This was like 10 days ago. And the market didn't believe it. The market thought they were just trying to get this thing to stop going down because they had to stop the margin calls. Then, I don't know, it was 5 days ago, they came out with a much more formal letter that said that they're going to offer $18 a share, that they have multiple, not one, but multiple highly confident financing letters, and they won't require much additional capital to finance the take private other than that, up to 100 million of their own money. The market is still very skeptical here, right? Stock's trading 1480 with an 18 bid, and people think they're just still doing this to stop the margin calls. Why do I like it? I like it because the 50% shareholder at the top is not in distress. There's been no liquidations from him. Okay. It's just been the 12% holder. And I don't think that this does much for them in the long term if they're not actually interested in acquiring it. So the question you have to ask yourself is it an interesting take private at 18? And it's a pretty good business. It's very, very moaty. It's very niche. And Facebook, of course, can't supplant Grinder. It's a very unique asset with a very dedicated customer base, and it's very hard to replicate that and have people go to another platform and get to that scale you need. And I like it because I think that it has really good private equity characteristics. Right, you could pay down debt rapidly over the next few years as you grow the business. And they have to put in very little capital to take this private, almost nothing. So your risk here is that the board rejects it, and it's the fair value is north of 18, and nothing gets done. I think that's hard to do if you're the board, right? This stock was trading in the 11s. It's now trading well below the bid. So the market's telling you that it's not worth 18 or more than 18, or else it would be trading over 18. And quite the opposite's happening, right? It's trading well below 18. So they're going to have a hard time rejecting an 18 or even a small sweetener from 18. And how long do we think this will take? I think am I talking through the Fed? I have the TV off, but I see the market moving and it's 11 o'clock. I guess it's okay. Congratulations, 25 basis point cut to your margin rates for all who celebrate. So I don't think they could turn this down. I think that the offer is highly qualified and legitimate. And I think you could have it done easily before the end of the year, but in the next 4 to 6 weeks. I don't think the due diligence has to be that complex with the financing. Obviously, the board members, the two major holders, already are intimately familiar with the company. So what's your break here and what's your risks? So they're reporting earnings next week. You have to ask yourself, are earnings going to be really good or really bad if they did this in the last few weeks? I go both ways, right? If you think this is a fake bid and they're only doing it because they're trying to keep the stock from going down and they're about to report earnings, then you do it now. You do it now because you want to keep the stock from going down, and you don't want your bottom to get liquidated. If you think the earnings are great, you want to do it now too, because you want to have the unaffected low, and you want to show that you're giving a nice premium. I lean more towards earnings are going to be just okay. The stock blew up in August on earnings. It was down a few bucks for whatever reason, for nuanced reasons. I'm not terribly concerned about earnings, given the dynamics of the situation right now. That bid's not going away, whatever earnings are. So in your worst case, I think maybe the stock goes down $1 if the earnings are below expectations, as people think that it's more likely the bid's fake. But again, they know the earnings. They're on the board. And they didn't make this bid without knowing those numbers. So your upside is 18 to 19, maybe even 20. And your downside is, I think this business is pretty good. So maybe the stock goes to 12, 11 to 12 in a break. It was artificially down there because of the margin calls. So it's kind of like a 3 down, 3 to 4 up. Again, I put it at like an 80% chance of it going through. And I like that. I think that's a good setup. So I did not buy it at 16 or 16.50 on the day of the bid, but below 15, I think it's pretty attractive. And that's why I started putting it on yesterday, and I'm putting it on today. BBIO, what can you say? All I did was talk about that last year. And I mean, I fucking nailed it, and I still own it. And I wish I had all the position I had on before the tariff bullshit in April. The amount of money that I pissed away, not owning that, but buying, SWTX, BHF, forward, it's just incomprehensible. So it's been a tough year with my trading decisions. I'm still up like 25 or 30% for the year, but I should be up a lot more given what biotech has done and what Bridge Bio has done and so forth. All right. I'm going to sign off now. Love you all. Oh, let me look at any questions if I have here. Hi, Matt. Curious if this is what you do full time. Also, how you manage to support yourself investing. That's what you do. Looking at the same thing as well. So I've been in this business my whole life. Um, when I was in high school, I was trading in the '90s. And, in school, in my high school, I would trade from school, day trading. Didn't know what I was doing. Using the phone from the office to call my broker. This is before cell phones and whatever. Um, in college, I was day trading, losing money. When I graduated college, I worked on Wall Street at a firm called Spear Leeds and Kellogg, which is a trading firm. And then I got a job at 23 at a hedge fund, where I learned everything that I know really as an analyst. I was there from 23 to 26. And then at 26, I started my own hedge fund with a couple other guys. I moved to San Diego. It was a value focused kind of event driven hedge fund, event driven really on a biotech side, not at all from a merger and acquisition perspective. Um, that fund was great, and then it failed miserably within a year of me starting it. No joke. It was first year was incredible, and then within 3 months after the first year, it just was a phenomenal disaster, and we ended up losing like probably 10% of original investors' money from day one. But we had a 35% drawdown. So I was 28 when that happened, and that was right in 2008, right before the financial crisis. Um, I opened up an Interactive Brokers account in the summer of 2008. I was 28, 29, and um, I did not have a substantial amount of money, but I had a decent amount to be able to. It was just me and my dog to invest, and I've never looked back. Um, I have been doing this full time since 2008, which is 18 years, 17 years, um, and I've had huge ups and downs. But I started out really well in 2009, 2010. I had huge years, and I've at that point, I always had enough capital in my portfolio to live off of. I get this question a lot. How do I support myself, my family? The way it works is my portfolio is all my assets, minus my house, which is mostly paid off. And I have a lot of margin debt as well. So then people ask, well, how do pay for everything? Which is I have substantial costs with 3 kids and, you know, uh, a very sick dog. The answer is I take money out of the brokerage account regularly. And when I pull money out, it just adds to the margin debt. So, it's a fluid situation. When I have to pull tax money out, sometimes that might be substantial. I have to prepare for that and make sure I have enough cushion in my margin debt to pull the money out. Now, I do not run that tight with margin. Okay. I have significant amounts usually to either handle a drawdown or to pull money out if I need it. So let me be clear. Um, um, what usually happens when I have margin problems is I have a huge drawdown, that a 20, 30% drawdown, and I have to start cutting positions because I have too much margin debt. And this has happened many times over the last 16 years. So long story short, yes, I do this full time. I did not just happen into it. I worked as a professional investor for most of my 20s before I started doing this full time. I would have it no other way. I love doing this. I eat and breathe it. It's my passion. It's my this and music are my favorite things to do. Um, uh, and be with my dog and my family. Um, and I love not having outside investors. I love being able to take the risk that I want to take. The reason why I started, my Twitter account and this YouTube channel is because I like the camaraderie of being able to talk to other people that do similar things that I do. Though I also am friends with lots of people that run hedge funds or work for hedge funds. But that's a whole different business, right? You have to take different amounts of risk. You have to size things differently. You have to answer to LPs. You have to answer to employees, answer to partners. And I don't have to do any of that. But it also makes it pretty lonely because you only have yourself to answer to, and to be there for when things go bad. When things go good, there's usually lots of other people out there that have also made money in the ideas. So you could celebrate in Las Vegas when things go good. You really have nobody to cry with when things go bad. So yeah, by the way, that reminds me, I forgot to say this. Twitter's all fucked up, and I can't accept people anymore on my account unless you're like a new request. There's no way for me to scroll and find you. So for all the people I told you I would accept, I'm not doing it to be mean. I tried really hard to do it, and I can't do it. So my best answer to you is try to block me and then unblock me and then click request again. And I'll keep trying and looking for you. So, put your name again in the chat when we're done, or in the comments below, and I'll try to find you. But that's the reason why I haven't let you in. It's not because I'm not really closed. The account's only closed unless people ask me, to come in. And that's worked really well for me because it's cut the trolling down to almost zero. I tweet my whole portfolio, and as a result, I got a ton of trolling back in my SRPT days. And quite frankly, it's no one's right to follow me and to see my trades and to see my investment ideas. It's privilege. I don't charge anything. So if I don't want you there, then you don't have to be there, right? I get some things out of some of you from camaraderie, but very little am I getting from a value added standpoint that I give a fuck if you follow me or not. So that's the reason why I have the locked account. It's more for me than it is for you. I don't ever put the Twitter on here. You have to figure that one out, though. It shouldn't be too hard, but I don't actually announce what it is. BBA call 3 in 2 days. Thoughts on covering for a bad earnings or perhaps 3 big wins in a row? I think it's going to be a great quarter, Alec. That drug is gangbusters. The launch could not be going better. I'm not at all concerned about the print this afternoon with BBIO, but I am just hodling my position there. It's like a 7% position now, very long-term capital gains, low cost basis. And I won't sell that thing really for anything. I'm going to hold it for a long time. They're building a powerhouse company now. I think they're going to have success in the phase 3 in quarter 1 of next year. And then that's going to dominate with a pill version versus a shot version. I feel great about it. Who would buy a multi-royalty company like PRTI? Few buyers, right? So since it won't liquidate, we wait for 2027. It's not about them being sold, but yes, the odds of it being acquired by somebody is very low. But they do have technology, but I think it's very unlikely that they would be acquired. It would be a liquidation or a turning into a holding company. That's the best I got there with PRTA. LQDA, the lawyer stuff and all this stuff is too much for me. I know everybody loves it. I'm staying away from that thing. It's just not my cup of tea. So no, I haven't looked at it. How much money do you need to do this in order to do this? 1 million, 5 million? That's a great question, Value Hunter 1. So the answer is it depends on where you are with your life, and it depends on what your cost expense is, and it depends on what your opportunity cost is for doing it. So if you're in your 20s and you have a few $100,000 or tens of thousands of dollars, and you want to do this full time, I'm pretty against it. I think it's much better that you make a living, earning, saving as much as you can, so that you then build up a war chest to be able to do this later on in life. You can also keep investing while you're working. That's the first thing. The second thing is I think you can learn more by hopefully working for somebody in finance. I know that's much easier said than done, but that would be my preferred route than doing it alone. But really, the problem is that if you start with too low of a pot, you're just going to be so stressed out about making a certain amount of money each year to cover your expenses. So let's just use like $1 million, for example. Okay. And let's say you're single and you're 30 and you have $1 million, which is a lot of money. Okay. I mean, no one should expect to make more than 20% a year doing this. Those are good, really good returns. I know we're used to all the screenshots on Twitter of people making 100% a month and all this bullshit. But over the long term, if you can compound at 20%, you're going to get very wealthy. Okay. But the problem is that let's do 20% of $1 million. That's pre-tax. So you made $200,000. Okay. Your taxes are going to have to be paid. It's not going to be all hodling like BBIO, where you don't have to pay realized gain taxes on it. Assuming, a decent tax rate, a quarter, at least a quarter of that 200,000 is going to go to taxes. Let's say a third, just to be more conservative. So your 200,000 is now 133,000, and you have to live. So, you only live once. So you're in your 30s, early 30s, late 20s. You should be living life decently, right? You should be going on vacations. You should be eating well. You don't need a nice car. You don't need a big house. All those things are big, a really nice condo. But that 133,000 is going to be burned. A lot of it. Is it 50,000? Is it 75,000? I don't know, but it's going to be burned. And now you're down to, less than 50 or 75,000 on top of your million. And that's if you make 20% that year. What happens the next year when you lose 20%? Well, now your 8 million is 800,000, and you've still burned through your 50,000 or 75,000 living expenses. You're down to 725. It's just very, very stressful. And that's assuming you have no family, no kids. You're just alone. So, to me, to do this full time, with kids, I think you probably would need to be in the multi-million, north of 3 million, maybe, to quit your job and do this full time. That would just be my personal opinion. Because I think you're better off making the money at your job and saving as much as you can, and then still investing part time while you're working. You don't need to put in 50 or 60 hours a week doing this. You could easily put in 5 or 10 hours a week on the weekends, learning if it's biotech you like, it's learning about, the different trials that are reading out that year. If it's the M&A crap you like, that doesn't require 50 or 60 hours a week. It doesn't require you being in front of the computer all day. I do find value being in front of the computer. I can't tell you how many times I've had money being made because I've been here. If you look at EA, when the articles dropped on the Friday afternoon, I put on a bunch of call spreads on EA that were 190 by 200 call spreads expiring the following week. And the stock was like 193. And I paid like $4 for those call spreads. And they all worked out. They paid out $10. And if I wasn't in front of the computer that day, I wouldn't have been able to buy them. And I've had stuff like this happen all the time. I've lost money too by being accessible. But a lot of what I do is just waiting. I'm just watching and waiting, and I'm here for the opportunity if it arrives. I also put on so many call spreads that I work orders all day. I'm just trying to get forward spreads off, or I'm trying to get whatever off. And, so yeah, that's a long way of saying I think that you can do this full time. You can do this yourself, but I would make sure you have a substantial amount of money to attempt it. Tell us about the dog. Oh, no. My dog was adopted about 7 years ago. And she's awesome, and she's dying. And her name is Maisie. So that's Maisie. We got her when she was like 5 to 7 years old. So we don't know how old she is, but she's got cancer and all sorts of other shit. I'm a saint, basically. Just call me Saint Matt. New Twitter followers. So Matt, my burn rate is 100,000 a year. So I would need 2.5 to 3.5 million a year or so to start. Yeah, I mean, that's kind of what I would think, honestly. Let's put it another way. So if you have $3 million and your burn rate is 125,000, that's a 3% yield on your capital. That seems doable, right? You should be able to have a mix of investments of different risk profiles to generate a yield on your portfolio of at least 10% a year. That's a mix of low risk, high risk, whatever, if you're any good at this, right? So if you use the 10% number as a conservative number over time, then you will yield $300,000 a year pre-tax, which is, of course, more than enough to cover your $125,000 nut. That's how I would approach it. If you start going much below 3 million, then you start having these Herculean numbers you need to hit. And that's not the way to do this, right? Then you start taking all sorts of risk. You start doing margin, which of course I do, but that's not the way to do it. And you start putting yourself in a position where you have to take more and more risk to cover your basic living expenses. And that's not the way to invest. And that's the way to doom yourself. Setting yourself up for failure. So I don't know, Value Hunter. I'm not going to say my Twitter account on here. So you can ask ChatGPT. I don't know. All right, I have to eat lunch. This was fun. Love you all. Till next time, let's get some fucking deals. Peace. Everyone take care.